Something strange is happening in the silver market, and almost nobody is talking about it the way it deserves to be discussed. On the surface, everything appears normal, prices move up, prices move down, traders debate charts, analysts write reports, and the financial media continues to treat silver as just another commodity drifting through the noise of the global markets. But when you slow down and look closely, when you step back from the daily price swings and begin examining the structure underneath, a disturbing pattern starts to emerge. Because the truth is that massive quantities of silver are disappearing from the market. Not slowly, not gradually, rapidly, quietly, and without any clear explanation. Before you go any further, like this video, subscribe, and turn on notifications so you don't miss what's next. Drop a comment below telling me where you're watching from and the current time in your country. Now, let's get back to the topic. Every few weeks, new data appears that shows another large withdrawal from vaults, another sudden tightening in physical supply, another unexpected strain in a market that is supposed to be deep and liquid. At first glance, it might look like normal market behavior. Supply moves, demand shifts, industrial users purchase metal, investors move in and out. But the scale of what is happening now doesn't look normal at all. It looks coordinated, it looks deliberate, and most importantly, it looks hidden. Because in a normal market, when demand explodes, everyone knows why. A new technology emerges, a new industry expands, a financial panic drives investors towards safe assets. Demand surges and the explanation becomes obvious. But that's not what we are seeing here. Demand is surging, yet the buyer remains invisible. No public announcement, no clear accumulation strategy, no identifiable institution taking credit. Just metal leaving the system, again and again. Truckload after truckload, vault after vault. And the deeper you dig into the data, the stranger it becomes. Silver inventories that once looked comfortable suddenly appear fragile. Exchanges that previously held large stockpiles are seeing steady declines. Deliverable metal, the kind that can actually be taken out of the system, keeps shrinking, while demand quietly grows in the background. And this raises the question that almost nobody in mainstream finance seems willing to ask out loud. Who is taking all the silver? Because somebody is, and whoever it is appears to be accumulating with extreme patience and discipline, not with dramatic market orders that would spike the price overnight. Instead, the buying seems structured, strategic, and methodical, almost as if the goal is not to chase the price higher, but to remove the metal itself. That difference is crucial, because in the financial world, price movements can be manipulated, markets can be influenced, paper contracts can be created in unlimited quantities, but physical metal is different. Physical metal cannot be printed, it cannot be duplicated, and once it leaves the vault system, it becomes very difficult to get it back. So when physical silver begins disappearing at scale, it sends a signal that something deeper may be happening behind the scenes. Now at first glance, some people dismiss this idea. They say markets always fluctuate. They say inventories rise and fall. They say supply chains adjust over time. But even long-time market observers have begun noticing something unusual. Silver flows have changed. For years, the silver market functioned like a quiet background system within the larger financial world. Gold attracted most of the attention because of its direct relationship to central banking and currency reserves. Silver, by comparison, was often treated as the smaller cousin, important but secondary, yet that perception has started to shift. Because silver sits at the intersection of two powerful forces: money and industry. It is both a monetary metal and a critical industrial resource. It is used in electronics, energy systems, manufacturing, medical technology, and countless other applications that modern civilization depends upon. At the same time, it carries thousands of years of history as a store of value and medium of exchange. That dual identity makes silver unique. And when demand rises from both directions at the same time, the pressure on supply can become extraordinary. Industrial demand alone has been growing steadily. As technology expands, so does the need for conductive metals. Solar energy systems require it. Advanced electronics rely on it. Emerging technologies increasingly incorporate it, in small but essential quantities. Each device may use only a tiny amount, but billions of devices add up. At the same time, investment demand has begun returning after years of relative neglect. For a long time, mainstream investors ignored silver entirely. Financial markets were focused on equities, bonds, real estate, and later digital assets. Precious metals were considered old-fashioned. Something changed. Gradually at first, then more rapidly. Confidence in the financial system has started to weaken. Debt levels have expanded beyond anything seen in modern history. Governments borrow at staggering scale. Financial markets rely heavily on liquidity injections and monetary intervention. The entire structure increasingly depends on confidence that currencies will maintain purchasing power over time. But confidence is not infinite. When people begin questioning the durability of the system itself, they start looking for alternatives. And historically, those alternatives often lead back to precious metals. Gold usually moves first, silver often follows. But when silver moves, it tends to move faster, because the silver market is far smaller than most people realize. If even a small percentage of global investment capital begins seeking physical silver, the impact on supply can be dramatic. Large pools of capital do not need to fully shift their portfolios. Even a modest reallocation can overwhelm the available metal, That is why the current situation is so fascinating. Because the withdrawals we are seeing are not coming from thousands of small retail buyers stacking coins in their basements. The scale is far larger than that. Entire vault inventories have been declining, deliverable metal is shrinking, and yet the price has not exploded the way many people would expect, which leads to another uncomfortable possibility. What if the visible price of silver no longer reflects the real demand for the metal? What if the price we see every day on financial screens is only part of the story? Because the modern silver market operates in two parallel worlds, the paper market and the physical market. The paper market consists of contracts, futures, derivatives, and financial instruments that represent silver without necessarily requiring the metal itself to move. These contracts allow traders to speculate on price movements without ever touching physical metal. The physical market is different. It involves actual bars, actual delivery, actual ownership. For decades, these two systems coexisted with relative stability. Paper trading created liquidity, while physical inventories backed the system when delivery was requested. But the balance between the two has gradually shifted. The volume of paper contracts has expanded dramatically compared to the amount of available physical metal. In some cases, the ratio between paper claims and real silver has become extremely large. As long as most participants settle their trades financially rather than demanding delivery, the system functions. But if large players begin demanding real metal instead of paper promises, the pressure builds quickly. And that appears to be exactly what may be happening. Someone, or perhaps several large buyers, is steadily removing physical silver from the system. Not loudly, not dramatically, just persistently. Day after day, week after week. And the fascinating part is how quietly it's being done. Because normally when a major accumulation strategy unfolds, rumors spread quickly across financial media. Analysts debate motives. Commentators speculate about who might be behind it. But in this case, the silence has been remarkable. Almost eerie. Large quantities of metal leave vaults, and the explanation is often vague. Sometimes it's attributed to industrial demand. Sometimes it's labeled as investor withdrawals. Occasionally the movement is barely discussed at all. Yet the pattern continues. Inventories trend downward. Physical premiums appear in certain markets. Delivery demand fluctuates in unusual ways, and analysts who track the underlying data begin noticing that the structure of the market is slowly tightening. Now imagine what happens if that trend continues. Imagine a scenario where physical silver becomes progressively harder to obtain, not because the metal has vanished from the planet. Silver still exists in mines, recycling systems, and industrial supply chains, but because available investment-grade metal becomes concentrated in fewer hands. When a strategic buyer accumulates a resource quietly over long periods of time, the true impact is often invisible until the process is nearly complete. At that point, the market suddenly realizes what has happened. Supply appears tight, prices begin rising, and everyone asks the same question. When did this start? But by then, the accumulation phase is already over. The metal has already moved, and whoever planned the strategy is holding the asset while the rest of the market tries to catch up. History has shown this pattern many times with different commodities. Strategic stockpiles build quietly, resource flows shift, and the market only recognizes the change after the structure has already transformed. Silver may be entering a similar moment, because what we are witnessing now feels less like ordinary market activity and more like the early stages of a long-term repositioning. A repositioning of wealth, a repositioning of resources, and perhaps even a repositioning of the global monetary system itself. But if that is true, the obvious question remains. Who is doing the buying? That mystery sits at the center of the entire story. Because markets rarely move this way without a powerful force behind them. And if someone truly is accumulating silver on a massive scale, they are doing it with extraordinary discretion. The footprints are there. The metal is leaving the vaults. The inventories are shrinking. Yet the identity of the buyer remains hidden. For now. And that is what makes this moment so fascinating, and potentially so important. Because when a critical resource begins disappearing quietly from the market, history suggests that the explanation eventually reveals something much larger than a simple trade. It reveals a shift in power, a shift in strategy, and sometimes a shift in the foundations of the financial system itself. Right now, the world is only beginning to notice the signals, but the signals are getting louder, and the silver keeps moving. The deeper you investigate the silver market, the more the puzzle expands. What initially appears to be a series of isolated inventory withdrawals slowly begins to resemble something much larger, a structural change in how physical metal is being treated across the global financial system. For decades, silver existed in a comfortable balance between supply and demand. Mines produced new metal each year. Industrial users consumed part of it. Investors purchased a portion. Recycling added additional supply. Exchanges and vault systems held reserves that could flow in and out as needed. The system was not perfect, but it was predictable. Today, that predictability is fading. What makes the current situation so unusual is not just the disappearance of physical metal, it is the timing of that disappearance within a much larger transformation taking place in global finance. Because while silver inventories are shrinking, something else is happening simultaneously. Confidence in traditional monetary structures is beginning to fracture. Around the world, governments carry enormous debt burdens. Financial systems operate with unprecedented levels of leverage, Entire economies rely on the assumption that currencies will continue functioning smoothly, and that financial markets will remain liquid under stress. For a long time, that assumption went largely unquestioned. But cracks have started to appear. Inflation has become more persistent than many expected. Interest rates fluctuate as central banks attempt to balance economic growth with price stability. Markets experience sudden volatility that reveals how fragile liquidity can be during moments of uncertainty. These developments matter because silver is not just an industrial metal, it is also a monetary metal. And monetary metals tend to behave differently when financial confidence begins to erode. For most investors, silver has historically played a minor role in portfolios. Large institutional funds rarely held significant allocations. Precious metals were often treated as a niche asset class rather than a central component of financial strategy. But the psychology of markets can change quickly. When investors begin questioning the long-term stability of currencies or the sustainability of debt structures, they start looking for assets that exist outside the conventional financial framework. Assets that cannot be printed, assets that cannot be digitally created in unlimited quantities, assets that exist in the physical world. Gold typically receives the first wave of attention in these moments because of its long association with monetary reserves. But once awareness expands, silver often enters the conversation as well. And when that happens, the scale of the silver market becomes extremely important. Silver's total market size is tiny compared with global financial capital. Trillions of dollars circulate through equity markets, bond markets, and currency markets every day. By comparison, the amount of investment-grade silver available in vault systems is remarkably small. This creates an interesting dynamic. If only a small fraction of global capital decides to seek physical silver, the supply available for investment can tighten very quickly. And that tightening can occur long before prices fully reflect the shift. Because the price visible on trading screens is primarily determined within the paper market. The network of futures contracts, derivatives, and financial instruments that allow traders to speculate on silver without requiring physical delivery. The paper market creates liquidity, but liquidity is not the same thing as supply. Actual supply depends on the metal itself. Bars stored in vaults. Bars transported across continents. Bars refined and cast into deliverable form. When physical demand begins exceeding available inventories, the system starts behaving differently. Delivery times lengthen. Premiums appear in physical markets. Inventories decline faster than expected. And participants begin asking uncomfortable questions about whether the paper market accurately reflects the physical reality. This is where the current situation becomes particularly intriguing. Because while the paper market continues functioning normally on the surface, physical silver inventories appear to be moving steadily in one direction. Out of vaults, out of exchange systems, out of easily accessible supply channels. And once metal leaves those systems, it often disappears into long-term storage, where it rarely returns quickly. Strategic buyers understand this dynamic extremely well. When someone intends to accumulate a large position in a physical asset, the last thing they want is a sudden price spike during the accumulation phase. Rapid price increases attract attention and encourage other buyers to rush into the market. So instead, the strategy tends to be patient, steady, gradual. Metal is purchased quietly across multiple channels. Deliveries are taken in manageable quantities. The process continues month after month while the broader market remains largely unaware. Only later, when available supply has tightened significantly, does the true scale of the accumulation become obvious. This pattern has appeared many times throughout economic history in various commodities. Strategic stockpiling is not a new concept. Nations have done it. Corporations have done it. Investment groups have done it. But silver carries an additional layer of significance. Because unlike many commodities, silver has monetary history embedded in its identity. For thousands of years, civilizations used silver as money. Coins circulated across empires. Trade routes transported silver between continents. Entire monetary systems were built around it. Modern finance eventually replaced metallic currency with paper and digital systems, but the underlying characteristics of silver never changed. It remains scarce, it remains durable, and it remains outside the direct control of financial authorities. That combination makes silver uniquely interesting during periods of monetary uncertainty. Now add another factor to the equation: technology. In previous eras, using precious metals for everyday transactions was inconvenient. Coins were heavy, transport was difficult. Dividing metal into small units required physical minting. Large transfers required complicated logistics. Today, technology offers new possibilities. Digital systems can represent ownership of physical metal while allowing instant transfer across networks. Precious metals can be divided into extremely small units digitally, while still remaining backed by physical reserves stored securely. This idea has been gaining attention in recent years. A digital token backed by physical metal combines the convenience of modern technology with the stability of tangible assets. It offers the speed of digital payments, without relying entirely on fiat currency systems. If such systems expand, they would naturally require significant quantities of physical metal to back the digital units circulating within the network. And if that network grows large enough, demand for the underlying metal could increase dramatically. Now imagine how this connects back to the silver market. A relatively small increase in global demand could absorb available investment-grade silver very quickly. Which brings us back to the central mystery. Because the withdrawals happening right now appear too large to be explained solely by retail investors purchasing coins in small bars. The scale suggests institutional activity, strategic activity, someone with both capital and patience, someone capable of operating quietly over long time horizons. But whoever it is has remained extraordinarily discreet. There are no public announcements describing a massive silver accumulation program, no press releases explaining a strategic shift towards silver reserves, just metal leaving the system, again and again, and the silence surrounding it only deepens the intrigue. Financial markets thrive on information. Rumors spread quickly. Analysts compete to uncover hidden trends. Yet this particular story has received surprisingly little mainstream attention. Perhaps that is because the implications would be uncomfortable if fully understood. If large players are indeed accumulating physical silver, it suggests they see something coming that the broader market has not yet recognized. They may anticipate rising industrial demand. They may expect monetary instability. They may believe silver is undervalued relative to other assets. Or they may be preparing for a future financial architecture where physical resources regain prominence. Whatever the motivation, the accumulation itself changes the market structure, because every ounce removed from circulation reduces the buffer available to absorb future demand. And when buffers shrink far enough, markets can move very quickly. Silver has demonstrated this characteristic many times in the past. Periods of quiet accumulation are often followed by explosive price movements. Once the supply-demand balance reaches a tipping point, that tipping point rarely announces itself in advance. Instead, the market appears calm until suddenly it isn't. Prices begin climbing faster, delivery demand intensifies, available inventories tighten further. And the world realizes that something fundamental has shifted. If the current pattern continues, silver may eventually reach that moment again. The metal quietly leaving vaults today could become the metal everyone desperately tries to acquire tomorrow. And when that happens, the question dominating financial conversations will no longer be whether silver matters. It will be how the market missed the signals for so long, because the signals are already there. They are hidden inside inventory reports, inside delivery data, inside the slow but persistent movement of physical metal away from easily accessible supply channels, all pointing toward the same unsettling possibility, that someone somewhere has been preparing for a future in which silver becomes far more important than it appears today. And that brings us back to the mystery that started this entire discussion. Somewhere in the background of the global market, massive amounts of silver are quietly changing hands. Vaults are slowly emptying, inventories are tightening, and the metal is moving into places the public cannot easily see. No headlines announce it. No single buyer claims responsibility. Yet the pattern continues with remarkable consistency. Maybe one day the identity behind the accumulation will become clear. Maybe the reasons will finally be explained. But until that moment arrives, one fact remains impossible to ignore. Somebody is taking an extraordinary amount of silver out of the market. And when the world finally realizes why, the price of that metal may look very different from what we see today.